Well, for more on how global stocks are performing, I'm joined by Won Sohn, economics professor at California State University, Channel Islands. Thank you for joining us.
Thank you.
Now, let's start with the Chinese market. How would you describe its performance so far this year?
It's been pretty bad, has declined some 22–23%, and we may not have the bottom yet this year. There are a number of concerns. The most important reason is, of course, the Chinese economy, the second largest economy in the world. Economic growth is falling below expectations. That's one. Also, we have seen volatility in the currency markets, and up until today, China's renminbi has been depreciating, which means that people are taking money outside of the country and going elsewhere, and some of that money is coming out of the stock market. Overseas, clearly, Fed raising the interest rate and problem with oil, problems in European banking system. These are all factors which brought down the stock market in Shanghai.
Now, staying in China, you actually talked about reaching that bottom. So going forward, what factors do you think are going to be perhaps some positive influences in the market's performance through 2016?
I think really the central banks will have to come to rescue. Certainly in China, People's Bank of China has done so. In Europe, European Central Bank, the Bank of Japan has decided, as she pointed out, negative interest rate. But the key is really the Federal Reserve. Right now, Chairwoman Janet Yellen has stated that they are going to stay more or less on course, not really specifying how often she's going to be raising the interest rate. But if we were to get some confirmation that the Central Bank of the U.S. will not raise the interest rate or even cut the interest rates, I think that would be very crucial in bringing the stock market in an upward direction.
And as you mentioned, the Fed being a potential area of concern, and we also saw recent roller coasters for Japan's Nikkei, the British footsie, Germany's DAX, and as you said, U.S. markets, among others. Which do you see as posing perhaps the biggest risk to the global market this year?
Clearly, I think China and the United States. If the Chinese economy continues to decelerate faster than we anticipate, and that's quite possible because the economy is going through a transition period through rebalancing. And if that's the case, I think this will have a global implications, not only in China, but elsewhere. The Federal Reserve, I think, historically they made mistakes, and I hope they're not making mistakes again. I think it's very important for them to stay the course in terms of not rattling the market. But my feeling is that the Central Bank of the U.S. may have made a mistake in raising the interest rate in December. So I hope that they will provide some calmness in the marketplace so that we don't have to worry about the stock market going down significantly.
So keeping in mind, we have the Fed. As you said, you think raising interest rates too soon. We have China's slowdown. We also have extremely low interest rates in other Western economies. And then this commodity crunch we have, including oil. How long do you expect this volatility to last?
I don't think the volatility will disappear anytime soon. I mean, I think the market was overvalued through the end of 2015. And there are many problems in addition to the stock market, the economy, the credit issues in Europe, economy in Japan, and then so global economic slowdown, the commodity prices, so that the volatility, I think, will continue. And so I think even though the market may temporarily rebound next couple of days or so, I don't think that will be a new trend. We should see continuing volatility throughout the year, maybe not throughout the year, but for a significant part of the year. Let's not forget the fact that based on weak fundamentals, stock market is a very, very emotional. They always overreact in both directions. And in 2006, they are more likely to overreact in a downward direction.
Now, one of the areas that's usually considered a bright spot or a safe haven is gold. Investors seem to consider it a safe haven. Do you think that's going to continue to be the case this year? And what could potentially change that momentum?
Well, I think gold is a safe haven, along with the Japanese yen and Swiss francs, and in some cases even the U.S. dollar. In a situation like this, investors are not so much concerned about what they are getting in terms of dividends or yields. They are more concerned about the preservation of their capital. And the best way to do that, some believe, is gold. So I think more and more investors are saying, I should put some of my nest eggs in gold. And I think for that reason, in 2016, the gold will do pretty well. But gold is not the only safe haven, as I pointed out, Japanese yen and then Swiss franc and then even US dollar. These are considered to be safe haven assets.
And going forward, if you had to wave a magic wand and try and decide what's really going to be the thing that could really bring things down, obviously we have oil starting to slightly rebound. We're not sure if that's going to continue to be the case. What do you predict?
Well, I think two things that need to happen. I'm not sure if that will happen. Number one, today investors are looking at the price of oil as a barometer of global economic strength. If the price of oil goes down, they think, the global economy is doing poorly, including China, so the stock market goes down. So if the price of oil were to go up for some reason, I think that would be a very good sign and indication. The second is obviously the Fed Reserve. If the Fed were to come to the rescue and not raise the interest rate or even lower the interest rate, which I think is possible, then we will see a significant boost in the stock market.
All right, we'll have to leave it there. Won Sohn joining us from Cal State University, Channel Islands. Thanks so much.
Thank you.